one, and then for people who want deeper analysis, we will put in more work, and that will be accessed with a paid account. That's coming, but for now it's all free and open. Make sure you take advantage of it. And we will also have a variety of promotions to give you better access. All right, so let's take a look at where we are in the, see if I can share my screen. Yep. So look at where we are with the price action with Trump's election. We got a pretty strong move. Just give me 1 second. Yep. We got a pretty strong move from in November. Massive jump, especially with all the hype around the strategic reserve. We reached past 100 and 108, and I think at some point 109. And then after that, the discussion of tariffs began, and people were, the whole time, people were confused about how it's going to be affecting the economy. Some people were even like, oh, tariffs are going to be fantastic and super bullish, and you got to stop selling calls and go long and all that, and you're not bullish enough and all of that. But we've been saying all along that tariffs are extremely bearish. They damage you both in terms of inflation and economic growth. And of course, it has panned out. We've had massive sell-off across all markets, and now we came down by 30% to 74. And then we are now back up to 84. Bitcoin actually has broken out of this channel that you can see. This up downward channel is broken up. You don't see this in other indices, S&P or other indices. So it's pretty interesting. Bitcoin, again, seems to have started to move much faster than everybody else. But also when you look at the price action, you see this massive decline, but then from here you see stagnation. So that's the pattern you see for bottom formation, right? We had a similar thing here too. You know, you get violent sales, and then for some point you get a slow momentum, and then you begin to build a base, and then you move up. Same thing if you look at the previous drawdowns. First you get rapid sell-offs, but then you get a slow price action. Now this is still downward, as you can see. Like, we still went down further, but the momentum slows, and this is where you build the base. And we're beginning to do that here, right? So we might still may still do a little bit of chop, but the fact that we are at the same price as we were early March, that's a really good sign. And I've been watching and publishing my analysis all the way down. This is where I went back into the market. So here I sold some MicroStrategy, and I think it was here around this time, maximum hype, maximum bullish sentiment. And then here I moved back in, long MicroStrategy, long MSTR calls, actually, long Bitcoin calls, IBIT, and a few other things. And a while later, around here, I also sold my short, both on IBIT and MSTR. So I'm beginning to lean more bullish as we begin to form this bottom. Now let's look at our report. This is something that we published on April 13th, Monday. Typically what we do is we write them on Sunday and schedule it to be emailed Monday morning to get you set up for the week. And what we do here, we spend numerous hours looking at macro and on-chain data. And it's extremely important, I think, to mention that understanding Bitcoin is not possible if you don't understand macroeconomics, right? There's a lot of Bitcoin specific analysis, but it just gets you so far if you don't link it to economics. A lot of the movements in Bitcoin is not coming from what's happening inside to actually external moves like this tariff thing. And so we have discussed this V-shaped market playbook for a while, and it has been extraordinarily accurate, not 100%, but I would say 95% accurate, and especially accurate in the most important areas. So initially, like I said, there was a lot of confusion about the effect of tariffs. We published a bunch of work, if you look at our previous articles, to explain how tariffs will actually impact our the economy, and I think I have a link to it. Yes. No. Somewhere. Yes, one of our previous articles goes into the actual theoretical side of tariffs and how they impact the economy. Essentially, we show how they slow down economic activity. So now, with that analysis, we realized that there would be a psychological shock before even anything is realized in the actual economic behavior. You get a shock because market acts early. So the moment they hear something, maybe they forget about it, they ignore it for a while until they figure out what's going on. But at some point, it typically is a very sudden moment where the market actually realizes this is happening, and then they become bearish. So you get a quick sell-off, and then I was expecting the inflationary part of tariffs will pan out, and again, since November all the way up to March, we had back-to-back high readings on CPI. And because of that, we were expecting neutral Fed, a Fed that's not going to promise any cuts and so on, and are going to be also be very, very worried about inflation. So that wasn't really good for the market. None of this was good for the market. Then we get to Liberation Day, and where Donald Trump announced much more than expected tariffs, which was terrifying for the markets. But the good thing about it was that we at least knew what's happening. We at least had a cap on the worst thing that could happen. So the markets didn't need to price in, Armageddon scenarios and so on. But another part of my theory was that the inflationary shock from tariffs would be short-lived. Why is that? Because initially, you get a supply shock. Things get a little bit more expensive as people are front-running tariffs. And we've actually seen this empirically. The imports have increased. A lot of people have stockpiled products. A smart move, by the way, that come from China or other countries so that they wouldn't have any trouble when tariffs actually kick in and they begin to limit a supply. But after that, as prices go up, people would pull back. People wouldn't keep buying. As they pull back, economic activity slows down, and we are hearing numerous anecdotes from businesses that they say, orders are canceled, and their economics doesn't work anymore. They're not ready for these tariffs. They are going to reduce production and maybe lay off, and all that is actually also reflected in the if I can find it, in some of the surveys of businesses. Today we got New York manufacturing survey, New York Fed manufacturing survey for April, and it's an utter disaster. Basically, for 6 months ahead, businesses are saying the conditions are terrible. We crashed. If you look at this number, general business conditions have crashed from 39 or so, or what is it, maybe 40, down to negative 7.4. So this is below zero, contraction zone. And then new orders, which is very important. This is a leading indicator. And they're saying that there are also no new orders that they're getting. So they're getting fewer new orders. And this is very an ominous sign for what's coming in the future. Shipments are down, and also back orders, unfilled orders are down. Everything is down. Everyone is bearish. Terrible developments in in the business world. And that's why you're going to get a recessionary shock. And we're getting it. Like, we've been talking about this for a while, but just in the last week, we've had Jamie Dimon warn about it. BlackRock CEO talk about recession. A bunch of other ones. Some reporters have reached out to me to publish on it. Bloomberg, for example, and many others. Like, now the R word is getting repeated a lot more, and we've been talking about this progression months in advance. So when this happens, you get disinflation, right? Because when nobody's buying and nobody's hiring, there is no appetite for risk taking. Inflation goes down, and all that is positive from the Fed's action, Fed policy perspective. So the Fed is likely to become a little bit more dovish. And again, we've seen that happen. If you look at the Fed Watch tool, right now for December, for the end of year, people are projecting a full 100 basis points or 35 basis points of cuts. Right now, the highest probability with a little bit of a margin goes to 3 rate cuts, but the Fed has only talked about 2, so the market is expecting more. Just a few days back, this was 4 rate cuts. But again, in the report, we've been highlighting this. At the time I was writing it on Sunday, we had higher chance of the 3 rate cuts. So the market is beginning to also price in more cuts just because of this economic slowdown. Another way to look at the slowdown is through the crude oil futures prices, WTI crude. And this has also been utterly crashing, especially after April, after the economy got liberated. This has crashed from 71 to 61. Typically, oil prices are heavily correlated with consumer short-term sentiment and inflation expectations. Plus, it's a great leading indicator for economic activity. If you're going to produce more and more, you're also going to need a lot more energy, and that will be reflected in price of oil. And if your economy is slowing down, oil prices are likely to go down. But some of this is also related to additional supply that's coming online. So Trump is actively trying to work with Saudi Arabia and other OPEC members to increase supply. But nevertheless, this is a clear sign of economic slowdown in hard data. Okay. Now, another part, so basically where we are with the economy is going back to our graph here. Where we are is we're in the recession shock. So we have to just give it some time to play out and kill inflation. We might still have a few inflation readings that are slightly higher because some of the tariff bills are being paid by businesses and some prices will go up and so on. But underlying is this huge deflationary force which comes from slowing economic activity. So eventually that will kill inflation, even if you might get some short-term spikes. When that happens, we would be in a fantastic position. Why? Because the bad news will have been priced in. The tariff problems will be much more predictable. Let me see if I can bring myself back here. And then you have a Fed that is not worried about inflation anymore and is ready to begin or accelerate cuts. We may not get a cut in immediately following meeting, but after that, we will have gotten a lot of terrible economic growth data and favorable inflation readings, and that will accelerate Fed's appetite for stimulus to the economy. Another part of my thesis was that one thing that could also really terribly tank the markets is federal spending cuts. You know, budget deficit is a bad outcome, but it pumps the market. So if they actually try to reduce government spending, it will crash the markets. But my thesis was that all this effort with Doge would not lead to much cuts. And more and more we are hearing that this is the case, and Doge is not cutting much of the costs. After all, this is very difficult to do. A lot of spending is related to entitlements and defense, and there isn't much to cut actually, unless you go through massively unpopular restructuring of entitlements. So Doge is also not showing its bearish potential. So that's another negative sign out of sight. So with all that, I'm expecting us to be slowly forming the bottom, as we also see in the market behavior. And once that happens, we get to the beautiful second part of the theory that is all positive signs. Like, especially, again, it's in Trump's best interest to crash the economy first, and towards the end of his term or later in his term, pump it as much as possible. First crash allows them to declare a win on tariffs and inflation. And then after, of course, later when we pump it all, it's all good news for them. And what they will be doing, which people are not really talking too much about, a lot of people are now focused on tariffs, but some of the super positive things that are coming later this year are tax cuts, unequivocally positive for the markets, and much more for Bitcoin. Deregulation also. Regulation is generally a negative thing. We want it to be minimized. It slows down growth, and once you deregulate, you get more innovation, more acceleration of economic activity, more risk taking, and more money, more liquidity everywhere, and so on. Especially if they allow banks to be more active and take more risk, you get massively more business activity and much more liquidity in the market, which will be absorbed by the best sponge there is, which is Bitcoin. The other thing I would say is there's a ton of money on the sidelines. Like, everything that happened in the left part of the graph caused this huge capital flight from the US. If you looked at the market, you would see that dollar index is down, bonds are down, stocks are down. Typically, you expect when stocks go down, the money goes to bonds, so bonds get bid up. Didn't happen. Bonds also sold off. Dollar also sold off. So people didn't even go to cash. People just altogether left the United States. And that's why you see outperformance in the international stocks. So is that a structural change? I don't think so. I think this is just a fear move. And once things come back online, once you form that bottom and you signal more stability and predictability and more confidence in the U.S. administration, that money's coming back. So there's a lot of hedge fund money, there's a lot of sideline money, international investor money that's now out of the market and sitting somewhere else in gold, in other stocks. And the moment they feel it's safe, all that money will also come back. So and they're smart. They know if tax cuts move forward, if the regulation moves forward, United States will once again be the place to invest in. And all that money is coming back, and we will see a face-ripping rally. And that's why we actually have this, that's why we write here, the face-ripping rally. So if you understand this as the game, what would you do? You try to build a position slowly, very slowly, but more heavily here, and get yourself ready for what's coming. So what I'm doing is I'm allocating a lot more in these places, in these areas, and I still have some more cash left, but getting aggressively long and covering my shorts. Essentially, I spend a lot of time understanding how the markets will behave, and it has paid off well. And I'll keep doing that and share the analysis with you. I really hope the rest of it also pans out, but this framework will weaken significantly. For example, tax cuts don't happen, right? So because we will still have some tariff effect left, but if some of these actually pan out, then they will outperform, or maybe they will recover all the losses and then some. That's why actually my graph ends up higher than where it starts. Okay, now the last part of the report looks particularly on Bitcoin. We use on-chain data to look at what's going on. In this chart, I'm looking at the short-term holder MVRV. This is a ratio of market cap of short-term holders to the realized cap, essentially meaning what is their unrealized profit. And we see that they are actually in an 10% unrealized loss, right? And when you compare it, this compares very well and actually slightly even dipped even below the bottom of the 2024 and also matches the bottom of the low of 2023 right before the huge run to 100K. Sorry, to the 70, 80K. This is before ETF approval and all that. So we are actually in severe pain. The pain level is equivalent to some of the best times to invest in the past couple of years. And also when you look at so this was unrealized profit, right? How much unrealized pain there is. But if you also look at realized profit or loss, you see that profit realization has gone down when we reached the all-time high, 109,000. People were massively selling. This is where everybody's telling you that 1 million is in sight and 500K is the next week and so on. Everybody's now, at that point, everybody's at the same time taking profits. So the market doesn't have enough juice to continue. And this was where I was selling calls aggressively, predicting that we can't really move forward too fast. But then the market crashed, profit taking went down. And here it reached its low, which is again comparable to the bottom of 2024, slightly more, if you can see, like if you're combining short-term and longer, slightly more, but kind of very, very comparable place. People aren't really taking much profits. There aren't much profits to be taken. So that removes one of the bearish forces from the market. And if you look at the realized losses, we want this to be high because this shows capitulation, and it is very, very high. It is, again, is at the level you could have seen in the bottom of 2024 in those ranges, showing people are in severe panic mode, right? And that's, again, a great thing. If with all this panic, we are stabilizing at 84, imagine what happens when the panic goes away and people don't have to sell. Okay, so the report basically shows that, if I wanted to summarize it in one sentence, we seem to be in this range, like maybe a little bit before the actual end of the damage. We're kind of in this phase. We are waiting for more recession signs to show. We are waiting for this inflation numbers to dwindle and clear disinflation signs to show up. We have early signs of this as well. The recent CPI reading was negative, so we actually did get a deflation month. And that's, again, matching our expectation. We want this to go on. We want a couple more serious disinflationary signs that will really scare the Fed and then change the game for them and make them compelled to continue the cuts. If that's the case, we're all good, but this is a fantastic place to jump in. Not financial advice. That's what I'm doing for myself. And I wish you guys are benefiting from this opportunity. You know, great opportunities only happen when people panic, right? And that's exactly when you want to have done your best work and do your homework so that you can capitalize on panic and realize that whether this is actually something that's going to end up in a disaster or this is something people are, overly worried about and willing to sell things cheap to you. And I've been talking about this a lot on Twitter, saying this is peak opportunity. We don't get these opportunities often, right? We got another similar one during the COVID time, right? You could have bought at extremely favorable prices just because everybody was expecting an Armageddon, right? And right now we are getting the same thing with tariffs. As the recession signs show up, there would be half the country which is against Trump policies, and they will be drumming up all the disastrous signs that are that they see. And there will be some, empirical validation. They will be referring to actual bad, terrible signs. But the thing is, markets bottom much before the economy. So we want a lot of the bad news to have been priced in, and we are getting there, right? And then the moment you're hearing about recession everywhere in the markets, and we are getting that this week, for example, like a bunch of high-profile people have been talking about it. Once that ramps up and you get a little bit of a sell-off reflecting that, you will, one great way to realize the crash is over is when you get very, very bearish sentiment, which cannot drag the market down, even if new bad data shows up. If you get that sign, that's the end of it. And then we'll be ready to go back up. But you don't have to picking the actual bottom like I did again. I want to mention, for example, here I was analyzing the market, and on March 10th, I brought back in most of my money. So I'm happy with it. It wasn't the absolute bottom. We actually went down a second time, but pretty close, right? And you want to be building the position as we go here. Maybe we go a little bit lower. Maybe this is the end of it. I doubt it's the end of it. There's still some more. Oh, sorry, I should have shown the chart. This is what I was showing. Yeah. So on March 10th, I had enough signs to be looking at the bullish side here, but then market gave several additional opportunities, so I leveraged this one too, and then I'm also adding more longs here. But I'm also expecting a little bit of a chop further because we need a lot more recession worry. People are still now having to waken up to the terrible damage that we are looking at. So once all that shows up and you get a lot of headlines here and there, then that's where this ends. But again, you just need to dollar cost average if you don't want to be following the market all the time. And also make sure you read our reports. We spend, again, a lot of time looking at two very important things, Bitcoin itself and the macroeconomic environment in which Bitcoin is. And we bring you the best of the analysis and signal that we can, so you can make more intelligent decisions. Again, if you want to sign up, just go on to 21stcapital.com/BI. This will allow you to make a free account and access everything. We also do have other features which would be super interesting on the platform, and these are some of our charts and proprietary models. For example, you could look at the Bitcoin quantile model, and we have an interactive version. We also have Plan C's beautiful version. The update times are different. This is updated once a day, so some numbers will be slightly different, but pick the graphics that suits you best. But we are at a median. So essentially, if you look at the full distribution of possible prices, we are at the median, which is a transition zone, right? It's, again, from a long-term perspective, this means a ton of the price action to the upside still has not happened. And we are actually in pretty favorable places for investing. So all that said, I wish you best of luck in navigating the super uncertain, volatile times. And hopefully we can bring you some clarity as all this is unfolding. Right now, let me take a quick look at some comments on YouTube. We're getting a bunch of comments. Awesome stuff. Thank you. Variba, thanks a lot. Thank you guys for the comments. Appreciate everything. Great opportunity. Thank you. All right. So no major questions. Thanks a lot for positive energy, everyone. And we will talk later.